to this week's Investing and Finance podcast. This is the fourth episode. I've been able to do it 4 weeks in a row. I'm very proud of myself. It's May 14th. Sell in May and go away is seeming to work. So we've had a bad week in the markets, but good news is earnings season is over. Very happy. I think we learned not a whole lot from earnings season, I guess. Tech is still dominating. The healthcare business is also not falling off a cliff. So other than that, generally speaking, at least, it does seem like sort of the continuing trend of the last decade of primary care drugs not selling well and specialty drugs selling well. That's certainly, it's nothing new and certainly seems to still be in place. We've seen that from a number of operators in drug side. On the tech side, what else can I say? It's really, historians will look back on this period, 2000 to 2020 is golden age. Really incredible changes to businesses and really amazing stuff. But I did notice that China now has an inverted yield curve. Some of you may be asking, what is an inverted yield curve? Well, I'll explain that to you in a second, but this is really notable news. I'm not a macro guy at all. I think you guys know that. But when I see an inverted yield curve, I definitely stop and ask myself what is happening, because it's a very unusual phenomenon. And so basically, long-term bonds should always yield more than short-term bonds. That's sort of the nature of borrowing money. You should, to lock up your money for 30 years, you should demand a higher yield, and you can see that right now, I hope you like my handwriting here, right now, borrowing money, the U.S. government can borrow money for 30 years, and it's roughly a 2.5%, 3%, 2.7%, something like that, I forget, kind of yield, and the short end of the curve is more like 1.5 or 2%. So there's sort of a weird dynamic that happens when the yield curve inverts, and it never really inverts too much in terms of sloping downward, but sometimes you'll see a flat yield curve, which is enough to call it inverted, really. And it means that, of course, you can borrow money, or the rate of the short end of the curve is the same or even higher than the far end of the curve, which is a really unique phenomenon. And the last two times this happened, there were two huge recessions right after. And basically the reason this happens is the market, which is somewhat smarter than everyone else. If you think about what the market is, it's this collection of opinions that is pretty clever. The market is sensing that there'll be short-term easing, and that short-term easing is, the short-term interest rate is almost completely what the short end of the curve represents. So if there's going to be short-term easing, basically what will happen is people will in essence sell off those bonds and flatten the curve, and that's sort of what's happening in China right now. I'll get to that in a second. But by selling off the near end of the curve, investors are expecting that whatever regulatory or I should say monetary body exists, they'll sort of ease to help the economy, which presumably is slowing. And that easing, of course, will result in lower interest rates. So it's a pretty simple concept, but it is a rare phenomenon, and almost always is a pretty good predictor of weak economic activity. So China, you can see this is the spread between 5s and 10s, and you can see that they've inverted. Now, the media made a big deal out of this. If you look at the actual yield curve, there is a lot of flattening, but it's still not quite totally flat. A little while ago, it was quite a steep curve, and now we've got quite a much flatter curve, the red line being the most recent curve here. So anyway, we're seeing that flattening in China, which is pretty scary. China's economy is almost as big as the U.S. now, so it's worth paying attention to. We haven't seen it in the U.S. yet. We still have a very healthy yield curve here, as you can see, which I think bodes well for equities. But in China, the flattening of the yield curve is very scary. That could drag the whole world down. And how you might manifest that in a bet, I'm not so sure. You can actually bet on a steepener if you wanted. You can, I always get the yields and things like that mixed up, but you can definitely bet on the near end of the curve by buying it and hoping yields will go down. You can short the far end of the curve and hope that yields go up. So
that's sort of the way you'd play a steepener or a flattener. But I think this kind of thing is really important to look at. And I also noticed the Case-Shiller Home Price Index is finally back to the 2007 levels, which is really kind of interesting. What to make of that exactly, I'm not sure, but it's important to kind of know how other asset classes are performing, things like bonds and real estate and things like that. So anyway, let's look at some healthcare stocks. Regeneron continues to rock and roll. I'm so proud and happy that it's been a good pick for me. I will have to eventually dive into that French stock, Abivax. I still haven't had the time to do it, but Abivax with their so-called HIV cure could be really compelling and interesting. And then finally, Valiant has been having this huge comeback. The funny thing about geometric returns, of course, as I hope all of you know, is that when you fall from 200 to 10, you need something crazy like a 2,000% return to fix a 95% decline. So it's very hard to make a comeback from kind of the, such a large fall in the stock. So the fact that the stock's rising a little bit, I wouldn't get too excited or too interested. Some people call it a dead cat bounce. I call it a dead trashy bounce, but regardless. The Immunomedics drug is really interesting. They cut the deal with Seattle Genetics, so that deal has been dropped. And I initially had some skepticism about this drug, but I have to look into it a little bit more because it could be pretty exciting stuff. Of course, AstraZeneca had some PD-1 news. I'll talk about that in a second. Allergan had some I don't know, the quarter was fine, I thought, and the stock dropped. It'll be interesting to sort of see how that plays out. Insight is a stock I'm short, and Acadia is a stock I'm short, and both stocks have dropped dramatically, which is nice. Horizon is a stock I didn't have a position in, and I noticed they had a really bad quarter, and I'll talk about that in a second, but I actually think it's worth buying here for maybe a bounce or whatever. GSK rose quite a bit last week. Y'all know I think I'm in GSK. Alexion fell due to a Brazilian raid of their office. And I don't know how law enforcement does things in Brazil. Right now they're pretty rattled about corruption. The president had to step down, I believe, etc. I don't think Alexion's doing anything wrong. I think Alexion's a great buy. Kite had this kind of weird situation. I admittedly have not looked too closely into it. Maybe next week. And Dermira also dropped pretty substantially, so I'd like to look into that. But that's kind of what I've been looking at in healthcare, at least in terms of stock prices. Now, interestingly, I've spent a lot of time recently on this hemophilia market, and so hemophilia is something that any pharmaceutical investor will have been familiar with over the last decade or two. Basically, there are these recombinant factors, either factor 8 or factor 9, and I think there's even a factor 7. But the point is hemophilia A and hemophilia B are caused by deficiency in factor 8 or factor 9, and there are a lot of big drugs that in sum generate about $10 billion. So this is really one of the best embodiments of biotechnology. You have these missing proteins that regulate bleeding and thrombosis, and of course in hemophilia, as we all know, there's uncontrolled bleeding, and so the clotting that is helped by this very complex factor cascade. It's not surprising that some things go wrong, and these patients need these either prophylactic or acute episode treatments, and these can actually cost, believe it or not, $1 million a year often, because there's sometimes if you have really uncontrolled bleeding, these patients will have to use a lot of the factor 8 or factor 9. They're really expensive drugs. It's a huge market dominated by a handful of players that you can see here. But I actually think this market would grow even further. I mean, these are really inconvenient, pain in the neck kind of drugs to use. And with these new therapies coming out, which could be curative, and I don't say that word lightly, I kind of call it the C word. I'm always nervous about, cure, just because it's so rare in medicine. But I'll show you in a second that these drugs are actually could be curative, and I think that means the whole market grows. It doesn't mean that these drugs disappear necessarily. They probably will disappear a little bit, or maybe even a lot of it, but they'll be replaced by even bigger drugs coming from these new companies. So who are these new companies? Well, there's a couple of them that are public, and I've bought stock in all of them. Spark, Sangamo, and Unicure are the three companies that I think are going to change the game for hemophilia. So Sangamo licensed one of their drugs to Pfizer, and Sangamo stock jumped in response to that, and Spark licensed their drug to Pfizer a while ago. So Pfizer has a couple of the old drugs, and they need to sort of stay in there. So why are we so excited about this? Well, Spark has shown their data, and their data shows that there's almost a 100% decline in usage of the recombinant factors, factor 8, factor 7, factor 8, or factor 8 and factor 9, I should say, which is, if you think about it, it's really amazing to have, patients who their whole life had to manage bleeding with these constant infusions. To have a complete disappearance of that requirement is really as transformative as it gets. It's kind of what medicine is all about, and I think this is kind of, I think people in investing kind of understand this is going on, but because there's some Pfizer ownership of some of this stuff, it's not greatly appreciated. And of course, what's interesting is Sangamo and Spark actually still own 100% of one of the two big hemophilia markets. So Spark actually still owns 100% of their hemophilia A drug, and Sangamo actually owns 100% of their hemophilia B drug. And I could see both of these companies be acquired for much, much higher stock price than where they're at now. Also, Unicure is sort of a dark horse here. It's trading at close to zero enterprise value, so I actually kind of think it's still pretty attractive. There's still some questions, like Baxter, I think, had a gene therapy drug, and we have to look at that. Not all of these drugs are created equally. It's also unknown whether or not they'll be really great long-term drugs, but I like all three of these companies. I think these are huge game changers. Hemophilia patients are really sort of have a terrible illness where they have to take these IVs twice a week, 3 times a week, 4 times a week, and for their whole lives. And these are medicines that with one injection, Spark saw 100% disappearance of factor usage, which, if you think about it, is really, such a miracle. I don't think the market's really truly appreciated the kind of upside that exists here. So I'm assuming you guys can hear me okay, but I'm gonna see if I can help that a little bit. So anyway, here's some of the data from the Sangamo drug, which has kind of been a crappy company for a really long time, and I think has finally kind of gotten their act together. You can see here that patients receiving different doses of the Sangamo drug not patients, but these are actually non-human primates, got these really enormous improvements in factor 7 levels, so above normal. Whereas the Biomatter drug didn't do so great, and the Spark drug is doing great, but the Sangamo drug seems extremely efficient, which is kind of interesting. Whether that translates into humans, we'll see. But I think these will all be multi-billion-dollar drugs, and they'll replace kind of the old recombinant factors, and you may only need to take them once or twice or whatever, and I think that's a really attractive place to be. There's still a lot of questions, but I do think that there's some upside in all of these stocks. So I have this current opinions list that I promised to update every week, but I also am going to be releasing a portfolio. So that'll be on the next slide, and you can actually monitor my stock picking performance and check that out. But basically, I added Sangamo, Spark, and Unicure to the list. I took one drug out. I took a drug company out. I took Mallinckrodt, and I moved it to fairly valued from undervalued. I put Bristol Myers on the list as well. And on overvalued, I took Seattle Genetics out, and so the overvalued list is a little short, no pun intended, but hopefully we can find some new shorts soon. Some of them may be in that evaluating category. We'll see. Anyway, those are a few of the things I'm looking at. And here's the portfolio. Now, one thing you should know about this portfolio is that I have very, very, very little gross exposure. I mean, now I'm up to 40%, but for most of the year, I've not been investing. So here's the weights as well. You can see that Alexion, Gilead, Regeneron are my 3 big picks. They're all large cap companies. When it comes to small cap companies, I've learned that it doesn't make sense to bet too big on them unless you're 110% sure, and I'm not 110% sure on anything right now. But those are sort of my positions and my weightings, and I'll update them weekly for you guys, which should be fun. And those are the shorts. You can see my biggest short. I have fairly good conviction there, but we'll talk about it some other time. So while my return is pretty small, you have to sort of think about the gross exposure. If I had 100% gross exposure, which would be more normal, maybe I would have a 18 or 20% return this year. So I think that's sort of the way I look at it. Now that I have a 40% gross exposure, the returns should pick up if, of course, the picks are right. But I've barely been invested at all, so that's just something to keep in mind. So what happened in healthcare this week, at least that I looked at, the PD-1 wars I don't think they're worth paying attention to. People talk about them a lot. Unless you're really focused on big cap stocks, I don't know that you really should care about what's really trial design techniques in different drugs. I mean, it is interesting to see, just as sort of a thought process, that every pharma is sort of chasing oncology and all of them have the same targets. So if there's ever a target in oncology, everyone's got the same drugs to those targets, and that's kind of interesting to me. Again, I looked at Horizon. My initial assumption is the stock's pretty cheap. I'm still looking at it a little more closely, and then we'll sort of talk about it from there. Kite, I have to look exactly what happened there. I'll have an update for that next week, but it seemed like they didn't disclose something on time. Novartis has filed BLA on their CAR T, so it'll be really interesting to see what happens there. Capricor failed. I think all stem cell-based drugs are failures and will not succeed. This private company, Guardant Health, raised $360 million, another mega raise. I think these mega raises are not, rarely are too useful. I think that, especially for non-pharmaceutical companies, there's this company and then there's Grail. I think both of these companies are going to have huge problems when they inevitably have to go public. I mean, maybe they're raising at a $50 million valuation or $100 million valuation or something, but I still think that, and I don't think that's the case, by the way, I still think that these are big shorts at current valuations, probably in the private world. Again, we'll see if the healthcare world is totally transformed by these kind of diagnostics companies, but I'm skeptical. Going a little quickly here, maybe it's the coffee I've been drinking. The GSK, which is a long of mine, has had some risk to Advair, and I think they're actually managing it pretty well, transitioning Advair to their new products. It's still their biggest product, but they have now avoided 2 kisses of death from generics. Making a generic Advair is pretty difficult, so I think that we'll kind of see what happens there, but every day that there's no generic Advair is a good day for GSK, so we'll see how that happens. Pharma, the PHRMA, the Pharmaceutical Trade Group, kicked out a bunch of companies. I don't think that this is going to help pharmaceutical companies' image. I think that we're living in a world where capitalism is somewhat being maligned in general, and I think that drug companies, even the largest ones, have been raising price, and I actually think, like many things in life, I'm sort of contrarian here, that the big price increases at big pharma are so despicable relative to the smaller companies, and they kicked all the small companies out, which of course are not the big fee-paying companies like a Eli Lilly or Merck or whomever. But when Merck raises the price of a drug 5% or Allergan raises the price of a drug 10%, they generate so much more revenue than a company like Horizon or Turing or Mallinckrodt or some of these smaller companies, that it's sort of ridiculous to pin it on these smaller companies when they're the companies that actually need the revenue, right? The bigger companies don't really need the revenue, especially if the smaller companies are actually doing research. Not all of them do, obviously. Like a Valiant was a relatively big company that did precious little research and raised prices a lot. Allergan, I would argue, is the same. But companies that are doing discovery research and lots of clinical trials, they kind of need that revenue. Whereas I think the Pfizers and Mercks and Eli Lilly's, I'm not sure that they need to raise price of Viagra 10% a year or Celebrex. To me, that seems like a sort of big, sort of glaring logic error in the PHRMA, which has never been an intelligent group to begin with, but it is something that sort of caught my attention. Someone asked me about stem cells, a little more detail there, and I'm happy to provide that. I don't think that stem cells, as they're given, really differentiate into the different lineages that they need to differentiate. And I also don't think that you can just intravenously infuse stem cells and hope that they somehow engraft correctly and that they're not just carried away by the vasculature. So medicine has to be precise, and it has to be very thought through in a very technical way. And companies like Capricor and others, many others like Mesoblast and many, many more I've shorted over the years, have not done it on a sophisticated level that's been too useful therapeutically. Again, drugs have to be designed with exquisite carefulness and detail, and these companies just sort of take stem cells and pray that they'll engraft correctly and differentiate correctly. And I think that there's a lot of theoretical risk in a truly stem-like cell that it will engraft into something bad, like a cancer or something like that. So there's no real reason to believe that the beautiful cascade that occurs embryonically can be recapitulated in by just throwing stem cells into a patient. It doesn't stand to reason, and that's why companies like Capricor and more will fail in my eyes. So we'll switch to tech briefly. So SoftBank is investing part of their fund. I think they've raised the $100 billion fund. It's more or less done, and they put $5 billion into Didi, which is the big Chinese ride-sharing company that bought Uber China. And I don't know a lot about Didi. I know it's got a big valuation, not far from Uber, and now SoftBank owns more than 10% of it. And again, whether or not it's a great investment, I'm not so sure. But I think it's sort of telling that SoftBank is going to be acting somewhat like just a really big Andreessen Horowitz style fund, or maybe that's not the most fair comparison, but I guess my point is that there are the safe, so to speak, safe spaces in tech VC. And I think that companies like SoftBank, to a certain extent, are acting like the major VC companies, where they're just sort of investing. It seems like, at least with this move, they're going to be investing the bulk of their capital into the mega unicorns. And simultaneously, they also announced the Improbable round. Now, Improbable is a software company that makes these virtual worlds. And if you haven't seen their software, I'd encourage you to go to their website, which I think is improbable.io. And what's kind of neat is, I actually think that this will be a write-off. Basically, Improbable seems to me something like a Unity type of engine, where again, we'll sort of see what'll happen here, but I'm not, and this is with the least amount of confidence and conviction you could possibly have, but I'd just as soon see Improbable disappear. There's sort of a state management utility for these procedurally generated worlds or mega worlds, and it's largely been a gaming tool. And I'm not saying that you can't make money making a gaming tool, far from it, but I wonder, if you look at the procedurally generated games, they have not sold well, and these procedurally generated worlds or mega worlds are not necessarily, we'll see if they become successful, but I think being a games tools maker, they have a lot more promise than that. I'm sure this $500 million will help, but I'm sort of skeptical. So anyway, SoftBank is sort of acting like the groupthink VC. They obviously do creative things, buying ARM and Sprint and things like that, so they will make their big bets. But this is more of and I don't think it's stupid, mind you, but they do seem to be just basically the big groupthink VC, which again we'll sort of see how that plays out, but I'm not so sure it's going to be a financially rewarding endeavor, but it may give them the goal, it may give them the information flow they need to succeed when they make the big bets. Anyway, Salesforce and Workday, No Man's Sky, of course, is what I'm talking about. I offered to buy copies of No Man's Sky for everyone when No Man's Sky came out because it was so bad, but that's neither here nor there. I'm looking forward to the Salesforce and Workday quarters. I think they'll both have gigantic, unstoppable quarters. I like both stocks. Salesforce actually had a really interesting thing that I had been trying to do for a year or so. I focused on a text summarization tool, which is one of the hardest and biggest sort of gaps in AI, and my staff and I didn't get too far before we shut it down, but it was a lot of fun. And I saw the news that Salesforce, and this is fascinating, has been able to actually do quite a bit of that work, which is really remarkable, and was one of the biggest, I think, missing gaps in AI. I mean, if a 12-year-old can read a book like Moby Dick or whatever and write a book report about it, why can't a computer? And there are 25 million entries into PubMed that I'd like to read. I can only get through a few a day, so it'd be really nice if they could be summarized for me and so forth. But or even you can get the next level of after the summarization, you could potentially be able to make inferences with that text summarization. So I probably won't get back into AI anytime soon. I think it's a sort of a weird place to be, and I'm happy for all these companies doing all this work. I like sort of these days in tech, at least I really enjoyed my time focused on the some of the AI work. But when I really want to invest in startups, that was sort of a mini startup, when maybe call it a project. When I really like to invest in startups, I like truly commercial, in-your-face kind of opportunities, not sort of blue sky research level stuff. So anyway, speaking of which, WannaCry, this big attack was a huge problem, and I've given some talks about why security software is probably one of the most exciting parts of the software world. There are so few security software companies. Check Point, Kaspersky, and a handful of companies dominated, and I think that the WannaCry attack, just which may be continuing, according to some rumors that it'll be even worse tomorrow in the U.S., that this is going to bring down our country. I hope it does not, of course, and that everyone is safe and sound tomorrow. But we are witnessing cyber warfare in real time, and companies like Check Point and others will only become more valuable, I think. And a startup, a great place to do a startup is security software. So anyway, that's sort of what I'm thinking about the tech news recently. Snapchat had a bad quarter. So Ronnie asked me to look at this. So in essence, I went back to my Facebook model, and I saw that in Q4 of 2009, this is 8 years ago, Facebook had roughly the same amount of DAUs as Snap. And unlike Snap, though, their quarter-over-quarter, or we just call it sequential growth, was 28%, which is an enormous rate of growth, and it was over 100% year over year, whereas Snap has obviously slowed down. So it's clear that Snap is really unlikely to ever hit peak users the way Facebook has, and I don't think that's necessarily their goal, but I do think that they're almost identical to Twitter, and you have a market cap of about double Twitter's with Snap, with about half of the. If you look at the similarities, it's really remarkable. We're watching Snap, basically, if you pull back Snap's timeline, I don't know, 5 years, maybe a little bit more, we're just watching Snap recreate Twitter, and it's sort of humorous, because it's really hard to sort of see Snap doing a lot better. At this rate of growth, when Facebook slowed to this rate of growth, they still got to double their DAUs before really slowing down, and that's roughly almost the exact same thing here. And in terms of revenue, it's also somewhat similar. If you count the ARPU, I do think Snap is basically turning into Twitter, and Twitter's worth half of what Snap is worth. So if you like pairs trades, you should short Snap and buy Twitter. And I think you're in a really good place because both companies will drop a lot, but Snap will probably drop faster than Twitter. So I think this sort of leads to one of my theories about incorporating new information. Traders are human, and traders have this problem, investors have this problem where they can't unlearn things. And if I've ever been a good investor, it's because I'm very quick and easy to sort of change my mind. And we've been told about how valuable Snap is for so long that when they have a quarter like this that's really a big slowdown, that we sort of have a tough time unlearning what we know about Snap. And of course, you might say, Martin, that's crazy that the market dropped Snap stock 20%. Well, yeah, but it should have dropped at like 70%. And one of the greatest things I've ever learned about investing is that you can often make the most money after the big move has happened, because investors are so slow to incorporate the news from that big move. And whenever you see a stock double, you should sit there and not bemoan that, oh, I wish I owned this yesterday. You should sit there and say, well, maybe it's only doubled, but it's going to go up 10 times more from here. And that sort of happened to Facebook. And one of my favorite situations was in 2006 when Celgene had some good data, or maybe it was 2007. And I started buying the stock even though it had gone up, it might have been 2005. I don't remember. Revlimid data just came out. It looked really good. And the stock had already gone up 50% or something. And my boss was upset at me because, he expected me to want to buy the stock before it got on 50%. But the reality is it was a much better buy after the fact because the risk was no longer there. We knew the facts, and the facts here are now known. We didn't know the facts before. We had no clue if Snap was going to be growing at a blistering rate or not. Now we know it's not. And we know that Snap DAU will probably settle in the 300 or 400 range. And so it's pretty clear to me that Snap is a great short, and that the market has this one wrong, even though there's been a 20-30% drubbing. So we'll sort of see what happens here, but it sort of boggles my mind that Snap is at the valuation it's at. So anyway, happy hunting there. This is an interesting sort of thing. Again, I want all of you guys to sort of move on from kind of I don't know how to put this, novice. There's a sort of slang word for novices in computer culture, but I won't use it here. I'd like you to move on from sort of novice investing to being sophisticated and sort of a little bit more, professional. And the Fama French model is something that in, 17 years of hedge funds, I have not seen once. And I think that, it's one thing for a group of internet observers to not be sophisticated in finance, but it's another thing for the financial industry to not be. Now, granted, the financial industry has been taken over by quantitative investors who are no doubt very thoroughly versed in Fama French, but I'd encourage you to look up some of the Fama French literature that's out there. And I think that you'll enjoy it because the Fama French model is just a simple, you can see it's sort of this regression that allows you to sort of predict the return of a stock based on, interestingly, unlike CAPM, a couple of interesting metrics here, like the size and the value of the company. So price to book, or the market capitalization of the company, which is really kind of a cool model. And you can play with your own models. And I want you to start doing stuff like this instead of thinking about technical analysis or thinking about what people are saying about a stock on Twitter or thinking about stuff like that. There is a real science to investing. And I'm not saying that you have to be you have to think about these in some monolithic or holy way. There's nothing holy about Fama French at all. But I think that it's really important to think about factors and investing from a different perspective. And people ask about Bitcoin or marijuana stocks, and it harkens, or at least I think it speaks very poorly about the person who's asking about it, because instead of a prescriptive thought process to tackle investing, what you're really doing is reacting. You're reacting to emotion. You're reacting to things you hear about, and that's the worst possible thing you can do, because investing should be tackled procedurally. If you're going to build a building, you wouldn't start right away and say, all right, well, I think the Leaning Tower of Pisa is a good building. Let me start building it. And you start building it, and you say, oh, maybe the Sears Tower is a good building. You start building it like the Sears Tower. Your building won't be a very good building by the end of it. And I think that people are scared to sort of look at a big system like the stock market and break it down and have a strategy where they say, all right, this is how I'm going to tackle this crazy stock market. This is how I'm going to start to think about what value I can bring into the world, and including my time constraints, and plan out a sort of battle plan. And for me, what worked relatively well was taking a sliver of the market, the biopharmaceutical market, which is about 10% roughly, maybe 15% of the stock market, and saying, I'm going to be really good at this 15%. And by focusing on that 15%, I was able to sort of divine some insights and things like that. But I think that, just picking up the phone and talking to stockbrokers and talking to your friends who may be at hedge funds or mutual funds or maybe like to invest a lot and maybe got lucky and you're following their picks, I mean, that's a great way to lose money. You're not taking a thoughtful approach to the market. And again, I encourage you to read the very arcane and dense things that get published, like in the Journal of Finance, which I think is one of the highest impact factor. If you guys don't know that term, impact factor is a pretty cool phrase. So finance, journal, impact factor. Journal of Finance is 5.29. You can actually kind of look these up, and you can see that here there are, I don't know, crazy, there's 214 total journals, but in the Journal of Finance is good head and shoulders above the next couple of ones, but these aren't bad either. And if you read these, largely academic, but occasionally someone like an AQR or someone will publish in one of these, you can learn quite a bit and start to take yourself out of that whole ridiculous culture where you're Googling for good stock picks, or you're thinking about and again, I'm not insulting anyone specifically, but when someone buys dry ships or AMD or something like that because they heard about it from somebody, that's we all know how that movie ends. But I'm not telling you that professionals are any different. Professionals have a word of mouth system on Bloomberg or AOL Instant Messenger or other tools, the phone, and they follow each other. And I would tell you that a good portion of the world's money is invested this way. And the quant investors are kicking the butt of the fundamental investors, but that's not because quant is better than fundamental. It's because fundamental investors often don't have a process. Their process is, let me look at whatever Goldman Sachs is telling me to look at this morning, or what the guy at so-and-so hedge fund capital management is looking at this morning, and that's the error. Having a process that's mathematical and procedural and logical is sort of what I think makes the most sense. And some of these journals may help you, not specifically because you're going to employ Fama French and make $1 zillion, but you may become more systematized, and I think that's what I'm trying to teach everyone in general. All right, so I got an enormous number of questions, and I want you to keep them coming, and I'm regretful that I can't get through all of them, but I'm going to try to get through more of them over time. But I think that there's a limited capacity for me to answer every question, so I'm sorry if I haven't been able to do them. I can't even read every question, which is somewhat remarkable. But anyway, one question I got was a pretty simple question. What is the best way to short a stock? Should I use Chris asked this question, and he said, should I use derivatives? Should I use puts? In other words, should I short the common stock? Should I do some kind of hedge? And it really depends on what you're trying to do. In general, I just like to short common. It's the easiest thing to do. Don't overthink things. I think that's the simplest way to short stock. That's what I do. ESG is environmental, social, and something metrics. And there's a Goldman Sachs, I guess, webcast or podcast, which I wouldn't listen to. It's just Goldman Sachs advertising that Phil asked about, that maybe that these metrics are actually the ones to look at, that maybe there would be some benefit to investing in companies that are doing social good and I don't know, environmental good. I don't think that's a good idea. I'll leave it at that. I think that one of the best ways to think about math is to, in other sort of pieces of logic, is extreme views. So if you take the extreme variable in this function and you say, okay, well, will the most environmentally sound and the most socially good company make you the most money, and vice versa? And if you think about it in the extreme, those don't stand to reason. The companies are not meant to be environmentally sound or socially aware or anything like that. Governance. Well, governance does matter. I'll you know what? I'll make this maybe lowercase e and s. Governance is important. Governance is very important, but I think governance is part of management. So I think that that's something to think about. But in terms of environmental and social, I think there's a sort of a difficulty in tying that to reality. Thank you for this meme, by the way. This is, I guess, Tai Lopez, who I don't know what he does other than make advertisements, but I appreciate the meme. Olsen. A lot of people ask me for a general model. Make your own. I have a 20-hour series about modeling, or maybe more than 20 hours, like 40 hours. Make your own, and send me your models, and I'll compare them with mine, and maybe I'll send you one back. But if you just want me to do your work for you, I don't think that's going to work. Someone asked me about multivitamins. I do not take any multivitamins. Even a diet like mine, which, as many of you know, is not very good, has all the vitamins you need. So I don't think you should spend your money and waste your money on nutritionals. Someone here, I think his name is Todd Todson, is I guess disagreeing maybe to put it bluntly with some of my views. You're welcome to call me if you have any guts. You can dial my phone number 646-217-2783, and I would love to discuss this further with you. Unfortunately, many of the people who disagree with me are challenged with respect to testosterone and are unlikely to back up the things they say. I have to edit myself a little bit. YouTube doesn't like any profanity in my videos. So in any event, I hope that you summon the courage, Todd, to call. But just let me know what your phone number is beforehand so I can just pick up that call, and I'd be glad to roast you in a very professional way. Someone asked me about Gilead M&A. Someone said, oh, well, Gilead's being too passive. Oh, no, I'm sorry. Someone said, what would you do if you were the chairman of Gilead? Okay, thanks, Elias, for that question. I do think Gilead's being a little too passive, but at the same time, it's easy to say that in hindsight. And obviously, this is a company that bought, they bought, of course, Pharmasset to get Sovaldi, and they made $50 billion in the process. So it's pretty hard to criticize them. And I think when you have investors like that, whether it's Gilead or Berkshire, of course, everyone wants Gilead to make some big move, but I think that, let's wait and see what they do. Let's give them the benefit of the doubt, right? Is Shopify the next Amazon, or are there other next Amazons? An intelligent question from Dustin. Obviously, I don't think Dustin was implying that Shopify was necessarily is necessarily the next Amazon, but nevertheless, I actually don't think that Amazon will. Their retail business will last forever, but their fulfillment network, I think, will. And I have a lot more to say on that, but I kind of want to do a startup around this, so I probably should keep it to myself. I do think AWS is here to stay, but I do think that shopping on the internet has not seen its last days in terms of innovation, and there's a lot more to do. Whether Amazon does it or somebody else does it, we'll kind of see what happens. With respect to the weekly Bitcoin and crypto questions I get, it's a little frustrating to get a lot of them. Hold on half a second here. It's a little frustrating to get most of them because they're sort of a bit overwhelming, and they're all sort of come from a naive perspective. Again, I think you should, for every Bitcoin question you have or fascination, I don't know why the fascination for it, basically there are way more interesting things to think about. Why don't you go ahead and learn about Fama French and other important and interesting things about the market than worry about Bitcoin and cryptocurrency. I don't think one is taking a serious study of all markets if you're just asking questions about Bitcoin. Someone asked me about SGYP, which is the Synergy Pharmaceuticals. I don't like this stock. I think any kind of IBS drug or mass market drug is not going to do too well. So anyway, sorry to dunk on you, Evan, but SGYP is not a good long at all. AVXL is worse than Neurotrope, which is saying something. Sorry, the person who asked that wanted to remain anonymous, but that was a big sort of a big issue. AVXL is a big problem here. So, in any event, let's keep going here. How do you select a discount rate? My answer to that is, what's the meaning of life? Andre is asking the question. So the core to all finance is, what's the discount rate? I mean, in essence, that's really, you're basically saying, how do I measure risk? Well, wouldn't we all like to know? Everyone wants to know what discount rate to use for what asset. It's a really tough kind of it's a tough thing to understand and learn. So really difficult to answer that question, because it's a question everyone wants to know. Everyone needs to know that, and discount rate is really a mysterious and nebulous thing, and it's hard to answer that question really any more than it is to answer the question, what is the meaning of life? Should we invest in index funds? So I don't think so. Hassan asked this question. I've given some videos on this. I think it's better to have liquidity, and of course index funds are liquid. So what I mean by liquidity is that you don't have the impact of the market's gyrations, and you don't have the risk of being whipsawed, which I think is kind of the risk of being long only. You're at the mercy of the market. You can sleep at night and focus on growing your primary earnings. It's a message that I've had for some time. I don't think you should expect any excess return from basic index passive investing. Sean asked me about Marcojodes and negative activism or short selling activism. I'm a big fan of it. I've done it for many years. I'm sort of surprised by the question. Of course, I like it. I've sent stocks reeling by just my very tweets. So of course, I think what Mark is doing is constructive. I like Mark. I talk to him here and there. I think he's a very good investor. Tim asked about using 13Fs to invest. I don't think that's a good idea. Looking at some hedge fund like Greenlight or Oxif or somebody and saying, oh, I'm going to buy their stock picks. I think that's a terrible idea. If you really like a manager, you should invest in the fund. If you can't afford to do that, then I don't know what to tell you. But it's certainly not a horrible thing. But please, just try to do your own research and think very carefully about it. Most investors are right 55% of the time. So there's no great way to really predict kind of where a stock will go based on who owns it. One question from Rob, which I think missed the point, but it's instructive nevertheless, is do you separate your investments into stocks you think are mispriced versus stocks you think the intrinsic value will change? So the two are the same thing, really. I mean, intrinsic value isn't supposed to change. That's why it's intrinsic. The value of a company includes the future expectations. So if you think the future expectations are going to change, it's sort of a circular logic. They should already be embedded in your forecast. So there's no great way to kind of answer that question, and it sort of misses the point, I think. So I'm reading 3 books right now. One's called, I just got it from a friend of mine. Thank you so much for sending me this. It's called A Madman Dreams of Turing Machines, and it's actually fiction, which is kind of interesting. The Innovator Solution by Chris Christensen, or whatever his name is. I don't love it. And then Breaking Rockefeller, which I think is a really neat book. And then I want to recommend 2 kind of websites, if you will. One is the MIT Technology Review, where you can easily kind of find that. And then Greg Manical's blog, which is an economics blog, which you might enjoy. So please take a look at those. Let's see. Last but not least, you can email me anytime you want, martin@thoughtpatrol.com. I do have a new Twitter. It's BLMBro. Don't tell anybody or I'm going to get banned. So please follow me on Twitter at BLMBro. Black Lives Matter hashtag. And then anyone who's watching this, I think, should go sign up for Godel.systems beta. It's pretty simple. Make sure to include your LinkedIn. We're only taking professionals who have a LinkedIn. So if you don't have a LinkedIn, you might want to consider joining LinkedIn in general, not just for my thing. But I think I've largely covered everything. If anyone else has questions, I will hold it open for the next 5 or 10 minutes. You can certainly call in as well. My phone number is there, so if you have any questions, feel free to call in. Thanks so much for joining. All right, let's see. Why did GSK try to buy Dare? I don't think that happened. So I don't know, Chris. I don't like that kind of talk. You're in timeout now. Timeout. Let's see. Yeah, I don't. I'm not getting any phone calls at the moment, but I'd love to talk to anybody who would like to chat. I think Joel asked a great question. Any software out there that helps with planning or procedural approach? I mean, I like to make my own, and maybe Godel will do some of that. Who knows? We'll see. I don't know Veristem well. GSK is really cheap, man. Let's see, we got a caller from Texas. Hello? Hey. Sure, let me just put you on speaker.
Going in the future,
yeah.
I'm hopefully going to be working in a hedge fund. I'm 19, I have a few interviews set up per week, but I'm really worried about the future aspect of quantitative investing. I want your opinion on that. If that's all right.
Sure. Yeah. No. Quantitative investing is one of these things where the firms that are doing it are doing really well. So I wouldn't get too worried just yet because they're really beating the pants off of kind of fundamental investors. And of course, it's a little silly to talk about quantitative versus fundamental because the best quantitative investors are heavily fundamentally factored. So I think that basically using a computer to help you do your job is not something that should be surprising that those investors are doing better than those who aren't, right? I mean, if you think,
yeah, of course.
if you think about it, that's really the secret sauce of quantitative investing is it's automating some part of the investment decision process or even all of it, but it doesn't remove the process. I mean, the process still exists, and to the extent that markets are very slow to react, I think there's still a good 10, 20, 30 years left of excess returns in quantitative investing. And I certainly, I think the more math you can learn and the more statistical methodologies you can learn and the more literature you can familiarize yourself with in the quant field, I mean, I think you're being very intelligent by doing that instead of, say, quote unquote value investing, which, again, there's good values out there. I mentioned in my last call that markets are usually efficient, but sort of 1 out of 10 times they shoot in the wrong direction. So 2 out of 10 times a stock will be either overvalued or undervalued, and 8 out of 10 times most stocks will be fairly valued. So I think that there's still a way to invest that will make plenty of money, but the long short business, the value investor hedge fund business has such a sort of issue with kind of sort of being successful in making money, and you can see that where funds like Two Sigma, Renaissance, and D.E. Shaw are making lots of money. Funds like Greenlight or Pershing Square or other sort of value investor type hedge funds are not doing so well. And again, there's plenty of value funds doing well, but in general, I think you need to start integrating some automation and some techniques. It's sort of like trying to run any kind of other industrial company like a fast food company or retailer or whatever without using technology. You'd be a little crazy. You could get it done, but in general, where would Walmart be without their IT system? I mean, it'd be really hard for J.P. Morgan to run their bank without automated loan systems and things like that. So anyway, that's my answer. Appreciate the call. Got a few minutes left here. There's a few more questions here. All right, I might be done here. There's very few questions. Do you think equity beta or correlation is a misleading factor in evaluating risk? So yeah, I do. Thanks, Bon Vivant. I'm glad you read the Super Investors article that I recommended last week. Correlation is extremely misleading. It's good for quantitative investing. It's really good for quantitative investing. But beta without some sort of interpretive guide is a really tough kind of thing to look at. It's the same reason selling premium works until you blow up selling premium. It's not predictive or causal of anything. It's backward looking, and it doesn't necessarily, at least individually, give you much perspective on the risk of a company's assets, but it does, with a big system, it sort of helps you quite a bit. I mean, something with high beta is probably riskier than something with low beta, but it doesn't mean that a high beta stock can't all of a sudden become very de-risked and a low beta stock can't get very risky very quickly. So conflict of interest, there's a lot of conflict of interest out there in the world, and you got to be super careful and watch for it. Cybersecurity companies considered tech companies or defense companies? Well, that's sort of getting blurrier and blurrier, is it? I only have one cell phone number, and that's the number I've given you. Can I talk to you about my depression, Martin? No, you should talk to a psychiatrist. What's the best way to join a hedge fund? Don't. I don't know why you'd want to. Become a math expert, and you can join a quantitative hedge fund, but other than that, I'd sort of avoid it. I talked about Alexan earlier. I really like what's going on. I don't think that there's a big scandal that's problematic. Why short Twitter? They don't make much money, if any, and the business isn't growing, revenue's declining. It's a big problem. We'll see what happens. I will be uploading this in a minute. All right, what else do we have? What else do we have? I don't follow Veristem too closely. Let's see if there's any new questions. NVIDIA versus AMD, I have no idea. Do I use game theory? Not really. How long before machine learning and quant investing becomes truly open to individual investors? I think that's a splendid idea, Sean. Maybe sign up for Godel.system. I have never tasted anything even remotely resembling what you've asked. I have no money. How do I make money? I've talked about this before. Just do your best to get good skill sets out there, and someone will pay you eventually. Doesn't Warren Buffett talk about growing intrinsic value instead of market price? Well, intrinsic value is in many ways, if you think about it as book value. Book value will grow over time, but fair value assumes book value grows. Every business that creates cash will have an increasing intrinsic value, so it's really not that interesting. The Boring Company, I don't know. I don't know what will happen with Elon Musk and his stuff. It'll be interesting to sort of see what happens. I think Tesla is a short. I'm really skeptical of Tesla. All right, a few minutes left. It was not GSK, that's for sure. You got to read that a little more carefully. GSK sold the drug to another company that got sold to Impax, that got sold to us, but it was not GSK. Statistical hedge funds, I mean, that's what I'm talking about, quantitative hedge funds. They're kind of the bee's knees at the moment. The last caller's phone number, I'm not going to give you that. I think people expect some privacy when they call me. But my phone is not ringing off the hook. Nobody's calling me, in fact, right now. Best skill to have in this current age? Same skills before, probably. Mathematics, philosophy, logic. Extensions of that include, computer science. In your investing career, if you've been long or short more on biotech stocks, I'd say pretty even. Pretty even. Would you work in Africa? No, I would not. Oh, Lord. Chinese internet stocks look pretty exciting. They have less transparency than American ones, but they're benefiting from some of the same dynamics. I don't think the French election will change very much. Change much. Yeah, I think China has got a lot of fantastic, tech companies. I read the Financial Times, absolutely. I don't know about Godel being publicly traded. Let's make it a valuable company first, then we'll worry about publicly traded. I think Jazz is still a buy. I do. What do I do most of my book reading? All day long. All day long. In the bathtub, believe it or not. What do I think about religions and God? There's some questions that I'm not very good at answering. Do I read quarterly hedge fund letters? Not really. I think 90% of hedge funds don't have a lot to say, and the returns would prove that. I do read Walt Whitman, yeah. Yeah, I know. I look at the kinase inhibitors. Of course, I've been looking at the kinase inhibitors since sorafenib in 2005. Oh, percentage stop loss. It really is. That's a tough one to answer. Does an inventor or product developer need a team to become successful as an entrepreneur? Yeah, usually. What's the average length of one of your stock trades? Probably about 6 months. 3 months, 6 months, something like that. Maybe 6 months. Am I a feminist? Sure. Why not? Depends on your definition, I guess. Yeah, I like 6 month moves. They're pretty. 3 months. You always want the moves in your stocks to happen as quickly as possible. But do I hedge? Of course. I have a lot of longs, a lot of shorts. I'm hedging beta. I trade options sometimes, sure. Chinese medicine is interesting. Steve Uslagi is a snake. What else? All right. Well, I really appreciate everyone joining in here. I went through it a little quickly. I think there was an hour of content, but I sped through the first 15 minutes pretty quickly there. So anyway, thanks so much for joining me, and we'll catch you next week, same time.